Sounds great.
It's 6 o'clock in London, 1 p.m. in New York, 1 a.m. in Hong Kong, 3 a.m. in Sydney, 10 a.m. in San Francisco, and 10:30 at night in Mumbai. Greetings, good morning, good afternoon, and good evening, wherever in the world you are today. My name is Patrick L. Young, the IPO video live stream, Series 6, Episode 1. This is show 31, ladies and gentlemen, goes live here. And let's begin with news of today's big birthday. The Intercontinental Exchange Group was born on this day in 2000 AD. To describe the group as coming of age on this its 21st birthday might be a decent marker against the sheer number of years that it has managed to exist, but that hardly surmises the incredible achievements of the group, which was once part of the B2B bubble, but became the ultimate survivor when that B2B bubble burst, going on to own some of the world's finest exchange assets: the International Petroleum Exchange, the London International Financial Futures Exchange Liffe, the New York Board of Trade, NYBOT, BOTC, the Board of Trade Clearing Corporation in Chicago, the Climate Exchange, and of course, that most famous piece of real estate on Wall Street, the New York Stock Exchange. This past month alone, ICE have set spectacular records with the launch of their ADNOC, that's Abu Dhabi National Oil Corporation, joint venture exchange, ICE Futures Abu Dhabi, or IFAD as it's known in the trade, recording a purely world record of 142,099 contracts in Murban Futures alone, as the Murban Futures contract looks to become the third global benchmark in oil futures after an unprecedented first month of trading. So happy birthday to ICE. And indeed, today it's fitting we have a senior member of the ICE team joining us for the IPO-VID show. More of our chat with Lynn Martin in just a moment. However, ladies and gentlemen, when it comes to the world of organized markets and the insights thereof, all this discussion and more has already been covered in greater detail in Exchange Invest Daily, the unique newsletter of the Bourse Business. Send us an email or hit me up on social media wherever you're watching this show today, Patrick L. Young, and we'll get you signed up so you can enjoy a 30-day free trial to understand the exchange business and indeed understand what the exchange leaders like Lynn Martin are reading every day about the Bourse Business itself. We call ourselves the Exchange of Information, or you might like to say in a more casual parlance, we're kind of the water cooler of the exchange business, as has been going on during lockdown when so many people have been unable to get to the office. So our guest today, ladies and gentlemen, is Lynn Martin. We're going to be talking about ICE bonds and much, much more, growing the portfolio trade. Lynn is president of Fixed Income and Data Services at ICE. She oversees ICE's market data, analytics, connectivity businesses, and its bond platforms. She's got degrees in computer science and statistics, so there's a woman who can certainly tell her C++ from her bell curves. Lynn has the dynamic background ICE needed to oversee such an important part of the ICE business. Prior to finance, she worked for IBM. Lynn joined ICE as part of the NYSE Euronext acquisition, where she was previously the CEO of NYSE Liffe, United States of America. Having completed considerable integration work, Lynn was named COO of ICE Clear US before being promoted to lead data services in July 2015, a role at the cornerstone of ICE's strategy to provide enhanced trading, valuation, and data services to customers around the world. Well, Lynn, good evening. Greetings to the show. Where are you today?
Well, thanks for having me. I didn't realize we, became legal today, as they like to say in America, with our 21st birthday. But that was a great introduction. So thanks for reminding us and the users out there, listeners out there, of that achievement. I decided to go very 2019 for my chat with you today, Patrick, and I am sitting in an office in New York City. It's been a fun year of toggling between working from home and in the office, and I couldn't take a chance on my home internet having issues during this call.
Well, that's wonderful to hear that you're in the office, Lynn. You're one of only a very small cadre of guests we've had so far who've been coming from the office. Funnily enough, actually, you're the second person to come from New York during the course of the last month or so. So that's obviously turning into a hotspot. Everybody says the city's dead. Clearly not in that case. So tell us a little bit, about your career. You've got this interesting background, statistics, computer science, and you went to work for, well, clearly enough, a benchmark in the field, IBM.
I did. So I think I broke a little bit of the mold there in that, I'm a female, and what I studied in university was computer science and maths. I was good at coding. I found coding as just another way to learn a language. You mentioned C++. That was one of the first languages that I learned, but I'm also going to date myself and say I did learn Pascal in college. So when I graduated college, I went to go work at IBM. Wasn't quite sure what I wanted to do, but I knew IBM was a great place to start one's career. When I was there, though, I realized that coding probably wasn't the place for me. I was someone who really liked to not just talk to machines, but also liked to interact with people. So I was pursuing my graduate degree in statistics at the time, and lo and behold, I came across an opportunity around the time of my graduation with Liffe, London Financial Futures Exchange, back in 2001. And I never really looked back from there. I've always done a lot of really interesting things. I joined Liffe when it was undergoing the transition from floor to screen. We had sadly just lost the Bund, and we were working on how we transition Euribor, short sterling, the curve products from a floor environment to a screen-based environment. It was interesting in that at the time, Liffe was looking for someone who didn't just understand the products or some of the theoreticals behind the derivatives markets, but they really wanted someone who knew how to code and understood how to talk to this emerging group of users, which was developers who had to conform to an API. So that was, where I got my lucky break in the industry, and went through a couple of acquisitions of Liffe. We were owned by Battery and Blackstone at the time. Got acquired by Euronext. Euronext got acquired by NYSE, and NYSE got acquired by Intercontinental Exchange, or ICE, as we're now known. So now the way you should think of how the ICE group grew up throughout that period is we've always been a company that has been focused on technology. That is how we started the company back 21 years ago, and that was to apply technology to financial markets to add transparency. Now, the other ingredient that adds transparency is data. So when you think about how we evolved as an organization, data and technology is the common thread in the core of what runs through our company, be it the exchange side of the business, more recently the mortgage side of the business as we look to revolutionize that industry. But then data is becoming much more of a commodity and something that is needed by the market to add transparency than ever before.
It's so interesting. Various things that you've said already spark an interesting moment. I see we've got a couple of comments coming in. First of all, delightful to see, I think one of your fellow female hackers, female coders rather, is saying, good evening, Lynn Martin. It's great to see another woman on IT hacking the future. That's a super piece altogether. And indeed, we've got a very interesting comment just come in from Christopher Messina, no less. Good evening, Christopher. Good to see you this evening down there in Florida. He was there. I was there during that special NYSE Euronext interregnum. What's the biggest change under the ICE banner? And there's an interesting question on management integration.
Yeah, so I would say that the biggest change under the ICE banner is what brought me to Liffe, London Financial Futures Exchange, back in 2001. The thing that I was most impressed with in 2001 is that you had technologists and business people solving problems together. Technology was the solution to the biggest issue that faced the Liffe markets in 2001. And that was, how do we protect our franchise? How do we move our markets electronic? Today, that same mantra, it lives and breathes everything that we do as a management team. How do we take our technology and solve problems, not just that we may have, but that exist in the marketplace? Most recently, how do we modernize the US mortgage industry? How do we continue to evolve market structure in my business, the very fragmented fixed income business? That is 100% a technology and a data solution to those problems.
And it must be really interesting. Great question, Chris. Thank you very much. And it must be very interesting because, as you say, Liffe was on the cusp of this changeover. And actually, you had that amazing situation where, in the crisis caused by the Battle of the Bund, and I'm actually going to publicize myself here, for those who want to buy secondhand books on Amazon, Capital Market Revolution, it's barely about $2 these days. And if you're lucky, you can still get a copy that I didn't sign at the time. Those are definitely worth more. The interesting thing about that whole battle was, of course, Liffe changed their business model so rapidly that they didn't have a front end to go to the client. And that was actually, I mean, that was so much of your job, was to go out there and go, no, to connect to our exchange, we'd really like you to buy some code, pick up some code, learn some code. We don't really care, but that's how you're going to get the market. And quite incredible.
Yeah, and as ICE evolved, they also adopted the same strategy for its markets, being platform agnostic, working with the ISV community, which has, evolved into the automated traders, the algorithms that are in the market who now code directly to the exchange. But at ICE, we always believed that we did need to have a platform, a low level, a backup platform, which some traders, depending on their strategy, still use as their primary solution, called Web ICE, which is like the front door to the matching engine. I feel like I'm back in 2001 sometimes, because it just shows the power that technology can really bring to a marketplace when it's applied appropriately.
Yeah, I mean, that's such an interesting point altogether, because, I mean, we're sitting here in this incredibly technological interface, but actually there was something about, oh, good grief, I can't remember now, it must be 7-8 years ago, we had David Pennicott, who was then running ICE in Europe, and he was on a panel at the Bergenstock conference I was chairing. And I remember he said something which just left me totally shocked, which was that at that stage, certainly in ICE Futures Europe, the biggest single area of growth was people who were connecting through Web ICE. Which is fascinating, because you would anticipate, certainly if you read the comics, that everybody's using 25 pointy-headed mathematicians to do something absolutely incredible.
Yeah, it really depends on one's trading strategy, though. If you look at a commercial user, they're position taking. They're not interacting with markets constantly throughout their day. They're not market makers. Market makers are going to go direct to an exchange from a technology perspective. They're going to code directly, or they're going to use a piece of software that they then interact with off the shelf. If you're a commercial hedger, though, you're probably going to go in, once a week, maybe once a day, and you don't need a lot of technology to establish your position in the market, or to manage the risk of that position in the market. So that's absolutely true. I mean, I think there's a place for all different types of technology, particularly if you look at certain contract structures where you've got open interest far out the curve, as opposed to something that's more of a prompt month or front month contract that's continuously rolling with each expiry.
No, it's fascinating. I mean, the dynamics of all of that. And just talking about interaction, which you mentioned, ladies and gentlemen, 2 ways you can interact with us this evening. First of all, send us a little bit of love, please. Like this page, wherever you're watching it. It helps get us up through the search engine optimization and all this incredible algorithmic wonderment. It doesn't have jitter or low latency, but nonetheless, it's incredibly complex in a programming fashion. And we'd love you to say something that helps get us further up the rankings. You can also interact with us. Ask us a question, as Chris Messina has already done. If you'd like to talk to Lynn Martin, the president of the ICE Fixed Income and Data Business. Now, I mean, I have to say, I don't mean to sound rude here, Glenn, but Fixed income and data. I mean, that's one heck of a job.
Yeah, I mean, I think it speaks to, a portion of my business and how we're thinking about solving some of the transparency and liquidity issues in that business. And that's really the fixed income business. We got into the fixed income business when we acquired Interactive Data, and that was back at the end of 2015. The reason why we acquired that business was because we saw the end of day marks, the valuations, on about 2.5 million securities at the time. It's significantly grown since then. As mission critical data for the fixed income industry that helps with price discovery, and it adds transparency. So since we acquired that business, though, we very much evolved the business into something that is not just used by back office for end-of-day marks and intraday marks, but something that is now used as a form of price discovery. Think tools like our continuous evaluated prices on 2.8 million securities globally provide near real-time marks and estimations as to what fair value on any of those securities can be. That helps traders when they're looking to make trade decisions, because if you think about fixed income markets, they have a very different market structure than the US equities market or any equities market, for example. The instruments, because there's so many of them, and they are complicated in their nature, you don't have people quoting those continuously throughout the course of the day, nor will you ever will. So it's quite difficult at times to figure out if I want to buy a certain ICE bond or I want to buy a certain IBM bond, what its fair value is in the market. So we provide tools that increasingly help customers figure out, well, what is fair value in the market. But that's just one of the tools that we provide. As you mentioned, we also have a variety of execution services, the ICE bonds platforms. The way I think about the fixed income markets is this is a workflow problem that exists in this market. It's not that firms are looking to an existing market structure to replicate it to find liquidity. They need a whole host of tools and services that help them make really informed risk management solutions. That could be our evaluations, it could be execution services, it could be indices, as fixed income ETFs are gaining in market share and predominance in the market. It could be analytics. It could even be, what are the underlying terms and conditions of a bond? So when you look at that market structure, it's got a lot of workflow and data type issues, which is why we made the decision to bring the execution business alongside the rest of the data assets that I had been running.
Such an interesting approach. I mean, really quite different to the way that this has evolved in other places. Yep. And also, if I may say so, I mean, your approach to the bond market has been intriguing in terms of trading, because you've given us some quite interesting basis of how you essentially, if you don't mind me saying so, I mean, you didn't really launch yourselves into trading bonds. You allied it into trading bonds by taking this data set, adding tools, the tools begat tools, and then suddenly, when I say suddenly, you have this incredible growth in trading. And I mean, portfolio trading, you'll remember the numbers better than me, but the two numbers that spring to me are what? Q4 2020, correct me if I'm wrong, you traded 1.9 billion, which is a pretty hefty number of bonds in anybody's book. And then Q1 2021, you traded 4.2 billion. I mean, you've been kind of doubling those numbers over the course of the last year, quarter by quarter.
Yeah, so one thing that we've seen is portfolio trading in the market has grown. I think it's now about 5% of US trace volumes. Trace is where corporate bond activity gets reported to.
We seem to have a slight freeze there. We were just discussing trace volumes, and Lynn seems to have frozen for just a second. There you go. She's back again. Hello.
I came into the office because I didn't think I was going to have problems with technology. And of course, while I'm talking about technology in the office, I have an issue.
Murphy's Law. Murphy's Law. So we lost you. You were reporting trace volume.
Yes.
Carry
So
on, please.
portfolio trading now represents 5% of all trace volumes. That is something that a year ago was probably about 1% or 2% of trace volumes. One of the reasons why portfolio trading has become, well, two reasons why portfolio trading has become more popular in the market. One is as a result of the growth in ETFs and firms looking to manage exposure to those ETFs and the baskets that underpin those ETFs. Portfolio trading is a great way to manage the portfolio and execute across a variety of bonds as opposed to just a single issue. The second is just the general liquidity and the ability for dealers to make markets in individual issues. Blocks still happen in individual issues, but a dealer would be able to give you a price much smaller notional on a single issue, but across a variety of issues to give you an equivalent exposure. So from a balance sheet perspective, it's actually much better from a dealer to offer you that liquidity through a portfolio trade. So those are just two examples of why it has become very popular. And as you mentioned, we've seen really, really good growth. We did have portfolio trading, prior to Q4, but Q4 is when we started to see the uptick in the community. We had a couple of asset managers come on, just under 2 billion. We had a couple more asset managers join in Q1, and it was over 4.2 billion. And Q2 is already off to a strong start.
Fascinating and very interesting, because when we look at this bond business, I mean, where do you think we are in terms of the overall evolution of the bond market going electronic? Because that seems to have been a permanent topic. I mean, actually, from before your career started with Liffe, people were talking about the bond business going electronic. And in those days, the guys at TradeWeb and so on were very optimistic. Now, no argument, they've done sensationally well. But at the same time, you've had this amazing, 20-odd year thing where, it's rather like Argentina. They always say that Argentina remains the world's most promising emerging market economy, and it always will be. And I've always felt the same thing about electronification of bonds. It always remains the great white hope for the next stage of exchange growth, and it sort of has always been. Are we now there? Are we seeing it really happening? And if so, how far have we got to go?
So I think I'm going to throw a silver lining on the last 14, 15 months we've all lived through in the time of COVID, and that it has accelerated the move to electronic trading for the corporate bond market. It was already headed there and had already made good progress, I'd say, a couple of years before. But the move to working from home, the move to not having everyone at their desks and how they exchange volume, the move to volatility that we saw, particularly last spring, really sparked efficiencies added to the corporate bond markets, which allowed the electronification. Now, I think it's important to define what the electronification of the bond market really means. It could mean things like responding to electronic RFQs. It could mean something like auto executing below a certain notional based on a certain price in the market. It's got a very different meaning than electronification of ETDs, for example, or electronification of equities, because it is a unique market. Do I think we will ever see a 100% electronic bond market or fixed income market? No, because 100% of the issues just don't trade every day. If you look at something like the US muni market, for example, there are over 1 million securities. Are you going to see those 1 million securities for every transaction that happens in them be electronically executed? No, probably not, because the liquidity profile is just so different in that market. So I do think there is room to go. I think there's a lot of tailwinds now that firms have figured out how to leverage data and technology to automate a lot of their workflows, but I don't think we will ever see 100% electronic the way we know electronic.
Okay, so that's a very interesting point. I think that's quite plausible. Viewers, if you disagree or you agree, let us know. Thank you very much, Marianne Madeira. Thank you so much for sharing your knowledge and experience, Lynn. It's really a great honor to learn from one of the most influential persons in exchanges. So there you go. You're bringing out the female coder brigade this evening. They're seeing you as a role model, Lynn, and that's great to see altogether. So in the midst of breaking that glass ceiling and breaking the bond market glass ceiling of electronification, let's look at that question in a slightly different way. And if you've got a question for Lynn, we've got just over 30 minutes on the clock still to go, ladies and gentlemen. Let us know what you'd like to ask. If we look at what's happening in the bond market at the moment, you mentioned portfolio trades. Now, yes, I get it. A tiny US municipality, the bonds basically get bought by somebody, they stay with somebody, they don't trade, they're minor issues. But the portfolio trading element, the ETF trading element, strikes to me the idea that we can see some sort of an acceleration in the overall degree of liquidity and trading. So therefore, there is possibly this, not maybe quite the graphic growth we got of exchange traded derivatives, but nonetheless, there is upside for the market to simply trade more often.
Completely agree. And fixed income ETFs and the fact that they've continued to gain AUM, even after the volatility last year, last March, April, is really a catalyst there too. ETFs, have a different market structure. They're equities. They're listed on equities exchanges, but the underlying instruments are fixed income securities. So you could argue that in some respects they are fixed income instruments. We've seen the growth in the fixed income markets just as evidenced by the growth in money that tracks our fixed income indices. So I mentioned, one of the workflow tools that we provide is a suite of indices across all asset classes. We have equity indices, we have commodity indices, clearly given who we are as ICE. But fixed income indices, we bought the Bank of America index business in 2017. When we acquired that business, it had about 95 billion in AUM benchmarked against it. As I'm talking to you here today, it's now got over 250 billion just in fixed income. If I look at my overall index business, it's got about 300 billion in AUM benchmarked against it. That's not that long ago to see that type of growth. We've had success because people continue to roll out ETFs. They select us as a benchmark. One of our benchmarks is the high yield index. We've got investment grade indices. Our muni indices are quite popular as well. But, we're also seeing firms select us as an index provider, moving away some assets from other index provider. Our preferred stock indices, which are traded on fixed income desks, despite the fact that their equities we just recently gained about $6 billion in those. So it is nice to see that there's more and more money flowing into fixed income ETFs, and that we have solutions, electronic solutions, that help those assets continue to grow in an efficient fashion.
And of course, the one thing I can't help but think about here is, what on earth might happen, and I'm going to say this, you probably can't possibly comment, but good grief, if we actually had something like the sort of yield curve that I studied at university, good grief, this bond market could go absolutely incredible instead of the quantitatively eased flat stuff we have at the moment.
Yeah, it's been interesting. So one of the indices we acquired from Bank of America is the MOVE index, which is Treasury volatility. And that thing has moved, no pun intended, around quite a lot in the last year. And we also have a swaptions curve called S-MOVE that we also have. So it is interesting to see, with the risk of Treasury increases, the risk of rates being raised, what the volatility will do over the near-term future. We definitely see it in our volatility indices.
Fascinating, certainly, how that whole volatility picture has still been huge, despite the fact that the actual yields are the square root of almost nothing. And in fact, nowhere is that more obvious in the corporate bond market than the way you managed to borrow as a group last year in order to complete your acquisition of various other mortgage assets, where essentially you were all but being paid to issue your bonds in the middle of the frenzy of Q2 of last year. I mean, absolutely incredible. I still think there's a big opportunity if that manages to move. So we're talking about move. We're establishing S-move, as you call it, which makes you a smooth operator. That's a pun I just had to throw in at this juncture in the middle of this show in order to encourage you to ask some more questions, ladies and gentlemen. Otherwise, I will offer some more puns the next half hour. We've got a good one, though, coming through from Wallet, the woman on IT. They've been inspired by you this evening. So they're asking, how did you shift your career from programmer into, they've called you CEO. That's very generous. We're not suggesting you're Jeffrey Sprecher, but you're clearly a C-suite staffer as president of the data, fixed income and data division. What would you say is the number one key for your success up that ladder so that other #women on it could follow you in IT to management?
Well, first of all, I'm thrilled that there are so many women in IT that are listening to this. So my hat's off to all of you and the jobs that you do every day. I always found programming to just be like puzzle solving. And at the end of the day, a little bit of luck that I found the right opportunity that allowed me to take my technical knowledge and use it in some respects in a public forum to deal with customers, which is something that I really enjoy still doing. But then, to also have the technical background to understand the problems at a very granular level. So I do feel like my technical background really prepared me for the way the industry has evolved. So it's a little bit of right place, right time, right background that has enabled me to progress my career and find a job that I absolutely love. The job that I have, I sometimes like to tell Jeff, when he offered me the job in 2015, he offered me the job that I never knew was the job that I really wanted. When he asked me to set up the group. So I think being in a technical capacity, it just gives you a different skill set than others may have coming out of college, things of that nature. So yeah.
Well, absolutely fascinating altogether. And thank you for that question, woman on it. And it's great to see altogether the interesting lineup indeed of women asking questions this evening. And of course, you were a C-suiter as COO of NYSE Liffe and various other positions during the course of your career. So let's come back then. I mean, you've talked about how bonds, fixed income, and data all work together. But data itself has become this outrageous explosion in the course of the last 20, 25 years. I mean, we've seen the electronification has allowed us to codify data, allowed us to organize data, and you're sitting on top of presumably now your own little, whatever it is, 15 petabyte lake or something like that of data that you're consuming at all points in time and pushing out to users. That provides not just a customer challenge, it's got to be an incredible IT challenge.
Yeah, and things like the cloud and on-demand computing and some of the newer technologies that have evolved in the market for data storage have certainly enabled us to store increasing amounts of data in a much more efficient way. Even the way we push data down to customers, we run a global network called ICE Global Network. And I would tell you, we offer a variety of port sizes, ports being the network connection size. We offer everything from a gig to 100 gig. The price of a gig is whatever it is. The price of 100 gig is not 100 times 1 gig. So there are technology providers are developing solutions that scale the problem in an efficient fashion. It's the only way you can compete. But I'd be lying if I didn't say that my data science group is not constantly asking me for approval to get more storage for alternative data and more processing power, and things of that nature. So it's a little bit of a challenge to keep up with from a technology perspective.
It's fascinating. The challenge is obviously multi-layered in so many ways. And as you say, interesting to think about alternative data, because you look at what we were used to when I was trading originally full time, and I mean, you got open, high, low, close, and everything came along, but you didn't even see the bids and offers of many of the US markets, for example, in exchange traded derivatives. Nowadays, I mean, we're used to this incredible granular amount of wholesale data, but alternative data has become such a vogue. And I'm really intrigued. I mean, how do you manage to ascertain what it is people want?
Yeah.
Or is it because people are coming to you and asking?
Yeah, no, it's actually it's one of those, you're not 100% sure where to focus your attention first. And one of the things my group has more recently become quite good at is taking unstructured data sets in the market and turning them into useful data. One area where we're seeing a lot of focus is ESG, environmental, social, and governance factors. Things like, are companies operating in a green fashion? So what is their greenhouse gas emission score? What progress have they made towards 2050 net zero compliance? Things on the social side, do they have stock purchase plans? Do they have healthcare benefits? Are women and men paid the same? And on the governance side, what's the average board tenure? Things of that nature. So that is an area that in the past has been considered alternative, but is now moving much more into the mainstream from an investing standpoint. A lot of times it is really interesting data, but it's really hard data to work with. One area that we've been able to successfully work with that data is through a partnership we have with a fintech company called Risk, RISQ, who measures geospatial areas in 100-meter segments. And we take that data and we're able to marry it together with our municipal debt valuations, our municipal debt terms and conditions. So the fact that we're able to stitch together climate risks that affect in 100-meter increments alongside the debt that would be affected by that is something that is unique and something that customers in the muni markets are increasingly becoming concerned about. If you think about that, just from a trader, as you were, Patrick, perspective, if you're trading the muni markets in California, for example, you may be trading two bonds, or you may have two bonds in your portfolio. One has wildfire risk, one doesn't have wildfire risk. It is really hard to figure out which one has wildfire risk, which one doesn't have wildfire risk. But with our data set, the way we've stitched everything together, we're able to tell you this individual QSIP expires on this day, fair value is Y, and it's got elevated wildfire risk, or in Florida, hurricane risk, or coastal flooding risk, or whatever the case may be. That should theoretically influence what fair value is on that market. So that's an alternative data set that is an emerging risk in the market that we've been able to stitch together. Additionally, because we do spend a lot of time, or I do spend a lot of time in fixed income markets, as you know, munis to me is just a fascinating market. And forever we've looked at the debt, what debt's valued at, but we haven't been able to stitch it together with the revenue side of the equation. So we just announced a partnership with ADP, who has tax receipt information, human capital management information on a variety of municipalities and areas and locations. So again, we're able to stitch together our muni debt alongside the revenue side of the equation. So again, it's another alternative data set that we're able to structure into something that the market knows and is familiar with from a risk management standpoint, and then allow the market to look at the overall holistic risk that an individual security may pose to the market.
That's fascinating in terms of also how that then keeps building the portfolio business that you're talking about in terms of
Yes.
the portfolio trading for bonds. So it becomes a beautiful virtuous circle of big data as you're going forward. So, I mean, this is intriguing. You're looking at the risks of what goes on in terms of municipal risk, in terms of climate risk, in terms of hurricane risk, things like that. Is there actually any limit to what we're potentially looking at in terms of the usage of data?
Yeah, I mean, there's not. I mean, you think about how the world has evolved. I think frequently, because I'm in the business, of how the world has evolved since I first started in the industry. When I first started in the industry, I'm looking for my iPhone right now to hold it up. That didn't exist. I'm gonna actually hold it up right now. I think I had a flip phone when I first started in the industry. This emits a lot of data. My browsing, what I look at every day, what I order on apps, where I'm located, what the weather's doing. So it is a bit of a virtuous circle in that humans are continuing through their interaction with electronic mechanisms, are continuing to output more and more data. Some of that is completely not useful, but some of that is useful for financial markets and for managing risk in financial markets. So I think that, the data world 2 years from now, 3 years from now, 5 years from now is just going to continue to evolve at a pace that, we've not seen yet.
Yes, it's absolutely fascinating. And at this point in time, well, actually, what you got to say is that anthropologists have just discovered that apparently we're completely obsessively using our mobile phones, which actually leads me to wonder whether we really need anthropologists, because I think we could have probably all answered that for ourselves without a problem. But that was something I saw in my news feed this morning. But it is intriguing, and certainly these devices, I mean, they show off so much data, and you look at the amount of data that individuals are using, which I'm going to offer a shameless plug now for something that had a little bit of handiwork from your boss, Jeffrey Sprecher, the chief executive of the Intercontinental Exchange and the chairman of New York Stock Exchange, who kindly wrote the foreword to this, My Tone, Victory or Death, all about blockchain, cryptocurrency, and the fintech world. And I mean, one of the things we talk about in that is, just how much data people use. And you look at the whole of the world didn't really get much beyond about a petabyte of data until about 1850. And then in the course of, the period since the Second World War, we're just seeing outrageous growth in data. The period from 1990, 2000 on, data usage just goes through the roof, as you know, because nobody under the age of 15 can possibly manage to talk to you at the dinner table because they're busy recording it for TikTok. And that starts becoming a very interesting thing, because obviously you're seeing the derivative trends for data and what it's doing for market data. And you think about our original floors, it's really, really fascinating. And I know that would instantly manage you to draw a response from Christopher Messina, because I know he's watching and he's an anthropologist. So therefore, let's give him the opportunity to say something. As a half-trained anthropologist, I left before I had to spend 24 months in a buggy locale. I can say with assurance that your headline summary lacked the nuance of the original finding. That's what they always say about these sorts of reports. Oh, you're just tabloid headlining with the extraction of whatever's gone on. But I think I might be onto something, Chris. Come on. I mean, if you look at your fellow currencies, but it's a fair point. It's an intriguing study of how humans are evolving to fit their data as much as their data is evolving to fit the humans. And I think that becomes quite an intriguing whole maximization of what's going on in the world. So we've got this huge amount of data going on. You're managing data across the whole spectrum. I mean, really every kind of traded data somehow or other goes through you. What are the particular hurdles you see in the relatively near term about trying to manage that sort of data lake?
Yeah, I mean, I'd say one of the hurdles that we have is, just continuing to keep up with the demand we see, quite honestly. We have a ton of opportunities on the whiteboard. My whiteboard, you can probably see behind me, is filled with stuff. But, it's really hard for us to figure out which one of those is going to be a game changer type product versus is just going to be, interesting, but not exactly land the plane where we thought it would. And that just comes back to, we need to continue to spend time with our customers. We don't like to develop things in vacuums. The ESG area is something that continues to interest me. That area is going to be an area that I think is going to continue to grow in importance. I don't know if 5 years from now we're talking about ESG as a thing, or if those risk factors just wind up getting embedded automatically as just part of normal disclosures. If that just becomes, a standard disclosure framework that companies, public companies in particular, need to do. So a lot of the times, though, in the data world, you think you're onto something, come up with a good proof of concept, talk to customers, you think you're onto something, and you get some false positives in the lab. So it's a lot of data that needs to be cleaned out there. There's a lot of data that when you actually put it into production, it doesn't have the exact benefit you thought it was going to have. And that's okay, because as I mentioned earlier, technology and processing power and capacity have significantly increased in an efficient fashion. So it's okay to have a couple of data sets that once you get into production, they actually do need to be on the floor as opposed to rolled out.
Well, but it's interesting, actually, because what you're talking about here is also a big history of the exchange industry. If you look at the classic era of the early financial futures and also sort of mega growth of commodity futures in the 80s and 90s, 90% of the products that were actually being created were built because it looked as if they had incredible features, and actually nobody really knew which was going to manage to succeed. And ultimately, the success levels were kind of the same as you were saying with startups. So I don't think that's terribly surprising, given how far and how fast we've come in data.
100%. You mentioned ICE Futures Abu Dhabi. I'd say, that's, we don't list a ton of new products at ICE, but when we do list a new product, as you saw with ICE Futures Abu Dhabi, it's rapidly turning into a benchmark. We're thrilled with the performance. It's definitely the most successful new product in our history. Question as to whether or not it's been the most successful new product in terms of uptake in the futures industry, but it's certainly got to be up there in the top 1, 2, 5 maximum, because it when there's a demand in the market, a pent-up demand in the market, and you list the right product at the right time, you do see folks adopt it. Same thing with a data set.
Yeah, no, it's true. And the IPO-VID story is incredible. 500 days in Genesis, 504 to be precise, including a very, very modest delay for COVID, which seemed quite incredible given the fact nobody could actually get to Abu Dhabi or get out of Abu Dhabi to go to either London or New York or Atlanta during the course of time. It's quite incredible. And certainly 142,099 contracts in the first month is unprecedented from anything we can find on our databases. And actually also interesting because you had Easter slam bang in the middle of the first month. So, that obviously reduced liquidity. Pardon me for saying so. Sorry, the pun, but, that is a huge knockoff of a couple of days in Europe, at least in terms of what goes on there. Quite incredible. One thing I'm interested in, we've got 10 minutes left, ladies and gentlemen. Can I just say, if you want to get a question in, you want to make a comment, remember, we end up at about this time in the show with anything up to a 60 to 90 second latency. It has nothing to do with the technology of intercontinental exchange. I don't know what it is, but there's a jitter in the world of live video streaming, and particularly if you're watching us on Facebook or LinkedIn, sometimes it can be quite acute. So get your question in now if you'd like Lynn to answer it while we're sitting here talking about ICE bonds and growing the portfolio trade and growing the wonderful world of data. Back to ESG, quite interested in that. One of the things that intrigues me there is, and this isn't necessarily your responsibility, but Ashley Alder, I think, has been quite vocal about this. A number of the head of IOSCO, a number of other people quite vocal. A lot of this stuff, particularly in the green, the very heavily green end of the segment, looks a little bit, how might one say, immature in the terms of the way that it's been benchmarked. There seems to be an opening where you can manage to lay 500 tons of concrete, put 10 solar panels on the top, and you can fund it with a green bond, which I may not be a great green expert, but it sounds a little bit dubious to me. I'm just wondering how you're seeing the efforts to really make a greater uniformity or benchmark ESG standards is coming along, and how that affects you.
Yeah, I mean, disclosures, there's not a lot of good standardization around disclosure of information to start off. We've taken the approach of, we'll provide you with just underlying data. We're not going to take the position of providing a rating or anything like that. We're just going to provide you with an electronic version of your ESG electronic footprint. So what are you putting out in your public filings? What are you putting out in your sustainability reports? Things of that nature. We go quite granular in the information we put out. We put out about 500 attributes across ES and G. I mentioned a couple of them before. And we QA it a lot. The concept that you were just talking about is something that frequently gets looped into the term greenwashing, which is, are you painting something as green when you look a little bit deeper, it's actually not green? That is something that data providers are continuing to look into and spend a lot of time and resources looking into. How do we verify? What are the audit standards around what actually gets put out to avoid those types of circumstances? Now, you think about how corporate accounting standards had evolved. I think something similar will happen for these types of disclosures in the future, but it's such a new field. I mean, to use a baseball analogy for those of you in the US, we are like maybe in the first inning of ESG disclosures in the market, in my opinion. We're nowhere near in the game. There's a lot of game left to play here. And I do think things like auditing and verification and certifications, things of that nature will come into play as the disclosure framework, which needs an awful lot of uniformity put around it, continues to evolve in the market.
Yeah, it's very interesting. I mean, I think you're right. It strikes me that it's not only what innings we're in, we're only in about the third innings of the first game of the World Series, and we're going to see a full long series of at least 9 games going through there. So it's fascinating to see what's happening with that sort of element of the greenwashing you mentioned. One other thing that quite intrigues me, looking at the whole pile of data, there's obviously an ongoing, how might we put this politely, tug of war, where certain parties are somehow or other complaining about the cost of data, but at the same time, there's this incredible expectation that you're going to produce yet more data over time. How do you manage to balance that tricky political situation?
Yeah, I mean, I think you've seen that overall, I think everyone just needs to take a step back in that debate and look at the cost of execution and how the cost of execution, whatever market, has really come down over time. And the reason for that is because there's more data. There are more products, there's more data. As a result of those products, there's more liquidity in the market. More liquidity in the market produces more data, which causes tighter bid-offer spreads. So I think it's a misnomer to look at one specific part of the overall ecosystem and complain about that one part in isolation. I mean, we certainly see that in the US equities market. US equities market is a completely fragmented, stitched together with Reg NMS, but fragmented market structure where a good portion trades in dark pools and off exchanges. And the one thing that unites all of the venues, which I think there's 16 venues, 17 venues, I've lost track, as well as the dark pools. The one thing that unites all that together is data. It's the underlying information. Where was best execution on a share of IBM? You got to look in a lot of different places, and the only way to stitch that together is through data. So complaining about one portion of, or voicing concern about one portion of the equation loses the overall phenomena in that bid-offer spread is compressed. The overall cost of trading to folks, retail, institutional, dealers, That has come way down in all markets, and there's more choice of products. And the reason for that, and there's better liquidity in all these products. You can get in and out so much quicker than you ever could before. And the reason for that is data.
Yes, it's certainly very interesting when you compare with, say, the Liffe exchanges you originally joined in 2001, which had 20, 30 single stock futures, plus barely a couple of dozen other contracts, plus 60 or 70, if there was even that, single stock options. And you just look at how many single stock options there are at the moment that are trading on the NYSE right as we speak, let alone all of those other, and good grief, I mean, oil, energy, gas. Yes, we're talking about Merban breaking through, but you can manage to clear a gazillion different contracts through the internet.
And the reliability of the systems and the performance of the systems and the investment that has gone into the cybersecurity around the systems. I remember when I first joined Liffe, to tell you an interesting anecdote, my first month there, 2001, we had just gone electronic, and the US was still not 100% connected to the Liffe matching engines in Europe. We were down for 42 hours my first month. 42 hours. The average response time, I think, was 5 seconds. Now we're talking about US equity markets, which open and close, trade and match millions, billions of transactions in nanoseconds, and have uptime, touch wood, pretty good uptime. So, there were some of the most reliable systems in the market, and there are some of the most hardened systems in the market from a cybersecurity perspective. That's taken a lot of investment to develop that market structure and to bring that market structure out to the customers.
Yes, and I think also you're even being slightly modest there, because moreover, that incredible uptime over the course of the last year with those multi-billion message days that we saw.
100%. 100%.
All taken.
That we saw in the last year, the equities markets, the futures markets. I mean, last year we had the oil interesting movements in the oil markets in April. So, and we've all done that from home. We've all
that's the point I was going to
support this type of market structure with intense volatility and significant moves and tremendous amount of transactions, record transaction volumes, all from home because of all of the technology that has been built.
And that's fascinating, because I think you're right. I mean, we've got this amazing big picture scenario of where we've been looking at how the marketplace has itself been run from home. And I think, you're saying this evening you're in the office and you're being deliciously 2019 retro. If somebody told you in June 2019 that you were going to run the entire marketplace from home for a year with you and the cat and everybody else's cats, and we were all going to get Zoom fatigue, you would have probably had a nervous breakdown just at the very concept that these systems were going to run like that.
100%. We were in a work from home company, and we very quickly pivoted to the remote environment with no disruption to our customers. I look at the hundreds of people that evaluate the 2.8 million securities that I have globally throughout the course of the day, and we were able to keep up with the market with no issues, which was incredibly impressive. So it's a true testament to our tech, our ops teams, that they've been able to harden the systems, prepare for this circumstance where it was just treated like another day in the office. Although, as you say, we were with the cat.
You're with the cat, yeah. I mean, the problem we're going to see next year, I noticed the UK, they've introduced a law today that's going to say that, sentience is an issue, and you've got to acknowledge that in your animals and therefore not treat them badly. Whether or not that applies to investment banks and their graduate trainees is yet to be seen in UK law. There's a test case coming up. But it's fascinating. The cats of the world are going to be very upset as we all start getting back to our offices full time. Yeah. However, I mean, we're reaching the end of our time here, Lynn, and it's been a fascinating discussion altogether. And I want to build on that. How do you see this marketplace going forward in a world where you've now had 10, 20 years of thoroughly exponential growth? How does it look to you in the hot seat?
I mean, I think there's still a need for risk management tools. I mean, I think the risks in the market just continue to evolve. Markets evolve, products evolve, risks in markets evolve. If you told me a couple of years ago what the risks that your typical trader would be managing, they're very different than what they are today. I don't think any of us would have expected the hyper volatility that we all saw in March and April of last year. And then the Fed came into fixed income markets to stabilize them a bit, which is good. And the way ETFs, fixed income ETFs, have really added to the liquidity in the fixed income markets. I think that it's just a fascinating industry. I think there's going to be a continued need for new and innovative risk management tools. Those could be exchange traded products. They could be new pieces of technology. They could be new pieces of data. They will probably be all three. And we didn't even talk about, the challenges that face the U.S. mortgage industry and how another silver lining going to work from home environment meant not everyone could show up in their lawyer's offices to buy or sell a house. So the way that technology and data is going to automate that industry is just going to continue to evolve. So net, I think that for the next 5 years, the next 10 years, you're just going to continue to see technology and data playing a key role in automating inefficiencies in the world and adding transparency that we never knew we were missing.
So market data is going to manage to stitch together the world of risk. It's a risk-based world. We're still looking at all of that. In fact, I can't help but feeling we've gone sort of full circle, because as I recall it, the Liffe exchange in the course of the 1980s, 1990s, it actually had an advertisement describing itself as the market to manage risk, because it was the major epicenter of that in the United Kingdom at that point in time, and therefore by dint of it, the rest of Europe. We've been talking, ladies and gentlemen, to Lynn Martin. She's the president, the woman in charge of data and fixed income, vast petabytes of influence, which are flowing through the 2.8 million securities that she's looking at every day, along with her team, many pointy-headed mathematicians amongst them, and quite a few cats that presumably during the course of work from home have managed to learn a great deal more about the concept of jitter, how data is stored, and much else beside. Transparency and data, pricing tools, how the ETF market has really moved forward when we were growing the portfolio trade are all key issues that are going on. There's a lot of game to play in the ESG field, as Lynn herself has said. And indeed, we didn't really get onto that incredible 25 to 30 year payoff in our entire lives. The mortgage market, something else which is being revolutionized by the whole of the business of the exchange world, in particular the Intercontinental Exchange. 42 hours of downtime in the first month of Liffe Connect in 2001. And by the way, everybody thought that was an unprecedented success. Exactly, that's the thing we've got to remember about it. No one talked about that. Nowadays, you lose 2 seconds and the entirety of the world is claiming that their entire marketplace has been destroyed. And you're talking about, 5 seconds of response time, whereas nowadays it's all happening in the time that it takes, I can't remember, a nanoscopically tiny business in order to manage to nanoscopically tiny organism, rather, as Christopher Messina, the anthropologist, would readily recognize, to, I don't know, flutter its wings 1 million times or something. It's a fascinating nanosecond world. Risks evolve, markets evolve. I can't help but feel, I remember the great comment, you were talking about ball games earlier, Lynn, and Paul Gallico made that statement of, why did he, when he was a journalist turned successful novelist, still want to go to ball games and report on them on a Saturday evening? He didn't need the money. And the reason, he said, was because all human life was there. And that's what you're bringing to these markets, whether they're coming through web ice, whether they're coming through low latency, whether they're coming for ESG, they're coming for the bond portfolio trade, whatever it is. Plamen Nakoff, you've had some interesting dialogue in the last ultra low latency minutes of this evening, along with Christopher Messina. My name is Patrick L. Young. I want to say thank you very much, LinkedIn users, Plamen Nakoff, Christopher Messina, Marianne Madeira, Women on It, all great questions all together. We're looking at towards a digital market profile next week with technical analytical geezer Clive Lambert. That's him in his floor jacket, actually, from the Liffe floor of Good Grief 25 years ago, that we're seeing something awesome, very, very retro for us all. And ladies and gentlemen, on this, the fabulous 21st anniversary of the establishment of the Intercontinental Exchange, I'm thinking of a parlor game, actually, Lynn. You put it in my mind. I mentioned earlier on many of the great acquisitions, the New York Stock Exchange, the London International Financial Futures Exchange, the International Petroleum Exchange. You threw in several more during the course of the evening, the Bank of America Indexes, business, Interactive Data Corporation, which is a huge element of what your business built out. But actually, ladies and gentlemen, while you're digesting this show this evening, wherever you are in the world, think about it. Try and name at least 12 acquisitions. We're not worried about 12 famous Belgians. We're worried about 12 acquisitions by the Intercontinental Exchange. That should get you thinking for the course of the next few days. I mean, that's going to be epic.
Our CFO, who's just retiring, his last day is on Friday. Scott Hill has been our CFO, wonderful CFO, done a lot of different things. He has done 40 acquisitions in the 14 years that he has been here. So 12 is definitely doable.
That's quite incredible. So I think 12 is obviously very doable, and that leaves me, I think, off the top of my head, about 14 short at the moment. So I'm going to have to go and study those as well over a drink after this show. Lynn Martin, thank you very much to our fabulous production team, to Beata, to Ola, to Hermania making her debut in the gallery this evening. Lynn Martin, this has been absolutely fantastic, talking about ICE bonds, growing the portfolio trade. My name is Patrick L. Young. Happy 21st birthday to the Intercontinental Exchange. Ladies and gentlemen, I wish you a great week in life and markets. We'll be back next Tuesday. Same place, same time.